Imagine waking up 18 months from now and 95% of the digital tasks currently performed by human hands in the Global 2000 are suddenly being executed by autonomous artificial intelligence. That is not a science fiction pitch. That is the actual strategic North Star metric we are looking at today in April 2026. Welcome to the U.S. Stock Picker podcast channel. Today, we are unpacking a $10 trillion shift in the enterprise landscape. We are moving away from the era of AI as a simple tool and entering the era of AI as a fully functioning digital workforce.
It really is the most significant structural change to the enterprise cost base since the Industrial Revolution. We are talking about a fundamental transition from software as a service to labor as a service. Think about how rapidly the landscape is bifurcated. In the Copilot era of 2023 and 2024, humans were strictly in the loop. We directed the AI to generate content or summarize a long email thread. Now, in the Agentic era of 2025 and 2026, humans are merely on the loop. We supervise while the AI executes complex multi-step reasoning across platforms. It is no longer about individual productivity getting a 20% bump. It is about total process transformation yielding 50% or more in pure efficiency gains.
That structural shift forces us to ask a profound question about the cost of labor itself. Traditionally, if a massive enterprise wanted to scale its operations, it had to scale its headcount linearly. You want more output, you are forced to hire more people. But this agentic revolution decouples growth from human capital, turning what was once a fixed human cost into a highly scalable variable cost. I look at the data from companies like Klarna, where AI agents are currently handling the workload of 700 full-time customer service representatives, dropping resolution times from 11 minutes to just 2 minutes. That is a staggering metric. But it also brings up a philosophical dilemma about the societal cost of this hyper-efficiency. Are we simply replacing jobs, or are we fundamentally altering what it means to work in a corporate environment?
That is exactly the right question to ask, and it is the core of the strategic roadmap for enterprise leadership right now. The companies that win here are not looking at which human jobs to replace. Instead, they are inventorying high-volume, low-complexity tasks to offload to agents immediately. We are talking about invoice processing, Tier 1 IT support, and back-office accounting reconciliations. The human role is shifting drastically. We are no longer the executors of the process. We are being reskilled as agent managers. Our value is entirely in handling the edge cases, the complex exceptions that the AI cannot solve. But getting to that 95% task augmentation is not a straight line. There is a massive governance wall we are hitting right now that is slowing down the timeline.
Let us unpack that governance wall. Because the sentiment data we are analyzing today shows a very bifurcated market. The C-suite executives are incredibly bullish, eyeing this massive margin expansion and decoupled growth. But the IT operations, and especially the security teams, are raising serious red flags. They are deeply bearish on the timeline. Why is there such a massive disconnect between the boardroom's expectations and the reality on the ground? What is actually stopping this digital workforce from taking over tomorrow?
It comes down to two massive roadblocks: data debt and the trust gap. Think of it like trying to build a state-of-the-art, high-speed rail system on top of a crumbling 100-year-old wooden bridge. AI agents are only as good as the data they can access. Right now, 55% of chief information officers report that their core applications are simply not AI ready. Enterprises are drowning in siloed, dirty data locked inside legacy systems. If an agent cannot access cross-departmental data reliably, it cannot execute. Then you have the trust gap, specifically the issue of agentic identity. If an autonomous agent makes a $10 million procurement error, who is liable? The software vendor or the enterprise? Current security frameworks are not built to handle AI acting as a privileged user until legal frameworks catch up. And until IT departments build proper agentic guardrails, this transition will face severe friction. It is an infrastructure play disguised as a software play.
That infrastructure bottleneck is precisely where the greatest investment opportunity lies. When we look at the fundamental analysis of this $10 trillion shift, the winners are not the companies simply slapping an AI label on their products. The true winners are the picks and shovels of the agentic revolution, those who own the workflow orchestration and the proprietary data. Let us look at the platform plays. Microsoft and Oracle. Why are they positioned to capture the lion's share of this margin expansion?
Because agentic AI is incredibly computationally expensive. By owning the cloud infrastructure, specifically Azure and Oracle Cloud Infrastructure, these giants capture margins at both the hardware and the software layers. Microsoft is the default choice. By embedding agents directly into Office 365, they completely eliminate the integration tax that usually kills enterprise software adoption. And Oracle has successfully pivoted into a high-performance AI cloud provider. They are attracting the massive workloads that require extremely low latency data access. Microsoft is sitting at $422.79 right now with a target of $590. It is a fundamental powerhouse with lower volatility than its peers.
And for an agent to actually provide a return on investment, it has to take action. It has to file a ticket, trigger a payment, or update a lead. That brings us to the systems of action. We are seeing Salesforce and ServiceNow in this space. Salesforce owns the ultimate system of record, which is customer data. Their Agentforce agents have the context of every previous interaction, making them fundamentally more valuable. But we are also seeing Palantir occupying a very unique niche. They are not just focused on productivity, they are focused on high-stakes autonomy.
Exactly. In regulated industries like defense, healthcare, and finance, an agent cannot just be fast. It must be explainable. Palantir provides that critical governance layer. Their AIP platform allows enterprises to actually trust autonomous agents with critical decisions. But while the long-term trend for all these names is incredibly bullish, the short-term swing trade environment is highly tactical. The market is climbing a wall of worry, and we are seeing very specific pockets of high conviction momentum alongside areas of tactical exhaustion.
Which brings us to the practical reality of trading this momentum wave. The long-term thesis is robust, but for our listeners managing their portfolios today, timing is everything. It is the difference between a 20% gain and a 10% drawdown. Let us pivot to the final segment of our discussion and deliver a comprehensive action plan. We need to synthesize the news sentiment, the fundamental strategy, and the swing trade analysis into a concrete roadmap for our listeners navigating this space.
Let us break it down systematically. First, on the news sentiment analysis, the narrative has shifted from experimental hype to pragmatic implementation. We are in a cautious realist phase. The C-suite wants the ROI, but the infrastructure wall is real. You must not chase AI-enabled labels. Instead, focus your strategy on companies solving the data silo and identity problems.
Second, from a fundamental and strategy analysis perspective, our overall recommendation is a tactical overweight on the sector. You want to own the infrastructure moats and be highly selective with the workflow providers. We are utilizing a risk parity model to ensure no single high beta stock dominates the portfolio risk, maximizing exposure to stable growth leaders.
Third, looking at the swing trade analysis, you must respect the 20% rule. Do not let your total AI swing trade exposure exceed 20% of your liquid capital. and always employ the news gap protocol. If an AI stock gaps down more than 4% on the open due to regulatory or AI safety news, you exit 50% of the position immediately to preserve capital, regardless of your original stop loss.
Fourth, let us talk about the buy and sell recommendations and when to start investing. For your core portfolio, Microsoft and Broadcom are strong buys right now. Microsoft is your foundation, absorbing lower volatility, while Broadcom is riding a massive institutional golden power trend. On the flip side, we are recommending a sell and take profits on ServiceNow. It is down over 36% year to date and in a confirmed bearish trend, testing heavy resistance. Harvest those losses and rotate that capital into higher relative strength names like Broadcom.
Fifth, exactly what price point to start investing at. For Oracle, we are looking at an infrastructure bounce setup. You want to accumulate and buy the dips in the entry zone between $172 and $174. For Palantir, it is a momentum breakout trade. You start investing only on a daily, close above $152, with volume at least 1.5 times the average. For Microsoft, set a buy limit order at $410 to catch any broad market pullbacks.
Sixth, when to leave the market. You leave the market when the technical indicators break down. Specifically, if the price falls below the 20-day moving average on high volume, or if the relative strength index pushes into extreme overbought territory above 80, signaling immediate mean reversion. You also step away if the remaining performance obligations of these companies stop growing alongside the AI narrative.
Finally, what exact price point to leave the market at to mitigate risk? For Oracle, you must place a hard stop loss at $166.50, just below the recent swing low, and look to take profits at the $192 target. For Palantir, mitigate your risk with a strict stop loss at $141 and look to exit and take profits at the $175 price target. For Broadcom, implement an 8% trailing stop to protect your downside while letting the open-ended trend run.
The transition to an agentic workforce is a marathon, not a sprint. We are witnessing the birth of digital labor. Own the infrastructure, be patient with the orchestrators, and always protect your downside. Thank you for tuning in to the U.S. Stock Picker podcast channel.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.